Involve yourselves. See, the first thing when we are doing the consolidation, we will just add these two non-current assets value. This is the parent, this is the subsidiary, right? And we will add this, and there was an adjustment which we have already discussed in the previous class. If you remember, there was a fair value adjustment, right? All the assets were equal to their carrying amounts, but except inventory and proper and plant and equipment whose like values were higher by this much collectively. Okay. And what we discussed that day when we did that adjustment, we wrote everything right on acquisition date. When the parent has acquired the subsidiary on acquisition date, this was the value what was higher for these two assets, right? The fair values were higher by this much for these two assets. And there a column was also there, if I'm not wrong here. Yeah. So at acquisition date, 300 and 200 were discussed, and this 300 is what actually related to inventory. You can see that adjustment also. Here we have at the date of acquisition, fair value of Sanus company assets was equal to their carrying amounts with the exception of items listed below which exceeded their carrying amounts as follows. The table we have already seen. The subsidiary company has not adjusted the carrying amounts as a result of their fair value exercise. The inventories were sold by Sanus company before the year end. Okay. So the inventories, the movement in inventory value is how much? The movement on date of acquisition is this much, right? The movement is this much, right? Yes. The at acquisition date, the values are this much, right? Higher by this much, right? At the year end, what is going to happen? Whatever the inventory you have, you are selling that inventory, correct? Now when the inventory is sold, do you think the movements will be shown? Whatever the higher value will be shown, you will realize cash for that, correct or wrong? Hello?
Yes, sir.
Yeah. So inventory is sold, henceforth whatever the inventory which we were showing is not there at the year end. You can see here. Okay. And all the movements would not be there because the money has been realized. That is what it is given here. And the balance sheet, in balance sheet, when you see the inventory, it is around 1200. So the point here is 1200 is the inventory. Okay. And here it is 300, right? That is the movement. That is the movement, right? So the inventory will become 1500, right? Yes or no? Hello?
Yes, sir.
And we see a movement of 300 here, right? So that movement is clearly written here on the date of acquisition. See, one thing you should understand, please. What you should understand is this is the value of the inventory at the end of the year, 31st December 2004. This is the value of inventory at the end of the year. Company has been acquired on 1st April 2004. That day, the inventory value was higher by 1500, right? Yes or no? 300, like in the sense on the date of acquisition only there was a movement. See, at the date of acquisition, the fair value of Sanus company asset was equal to their carrying amounts. The carrying amounts what we are seeing in the balance sheet is at the end of the year. Let me be very frank. Okay. But these two items, inventory and non this particular property, plant and equipment, their values were, it seems, like Sano's company, but the exception of the items listed below which exceeded their carrying amounts are as follows. So whatever was the carrying amount on 31st December, no, 31st December is at the end of this year. 31st December, no, not even that. March 31st, 2004. This is the date. This is the after this date, right? The company was acquired. Isn't it so? So when the company was acquired on April 1st, that is exactly at the date of acquisition, the fair value of the assets was equal to their carrying amount. So whatever the like assets were shown in the balance sheet, that amount and the market values were same only for these assets, inventory and PPE. The values were higher, it seems, for these two by this much amounts. 300 and 1200. What we are seeing is at the end the inventory is 1200, right? Yes. So I even can't say one point. I will explain you here. When I'm saying 1500, like really speaking, the inventory value on 31st December 31st 2004 is 1200, correct? So this is what I'm showing at the end of the year, and on date of acquisition April 1st 2004, the inventory whatever was in the books maybe as on that day, okay, market value was 300 more than that. Is it right? Hello, hello, are you people
Yes, sir.
following what I'm saying? Yeah. So so we have to put the dates very clearly. 31st December battery, yeah, 31st December 2004 is the year end. On that day the value of the inventory is 1200. April 1st 2004, which is the mid of the year, the inventory value is higher by 300. Okay, but what is the actual value on April 1st 2004 for that inventory? What is the exact carrying amount? Hasn't, we don't have an idea of that, right? We know the year end values, we know the movement in that values here, that's it, correct? Do you have the balance sheet on this date as on this date? No, this is the balance sheet of year end, but that's what I'm pre-assuming. So clearly the movement is there, so that we are doing a fair value adjustment here. Fair value adjustment is nothing but wherever the values are higher or lower has to be adjusted. So inventory value is higher by 300 than its carrying amount. Property, plant and equipment value is higher by its carrying amount by 1200. So the total fair value adjustment here is 1500. Now the movements what it is, right? At the end of the year the inventory is sold. When the inventory is sold, that means the cash is realized. Now this increase or decrease whatever is there will not be shown in the books, it will directly go to the cash account, right? So this is now not there. Am I right? Yes.
So can you repeat, sir?
See, this inventory has been sold, right? So when inventory is sold, the cash will be realized and inventory will not be visible in the books right now, correct?
Yes,
Hello.
sir.
So the movement which has happened has been realized, the cash has been realized for this, correct? Because the inventory is sold, the adjustment is very clear. Here you can see inventories were sold by Sano's company before the year end. So, so whatever the inventory, that means 1200 they are showing in the books, but before the year end they have sold inventories, it seems. So when the inventory is sold, do you think any movement will be shown now?
No, sir.
See, when you sell the asset, property, plant and equipment, any accumulated depreciation will be seen in the future or it will not be seen.
It will be seen.
What are you saying? How come it will be seen when the asset is not existing? It will be
Oh,
removed.
yes, yes.
Please, please watch my tangible assets videos, 1 to 7 videos which I have given. That is F3 videos. Okay. In that all the basics are there. So the asset is sold, its history will also not be there. So this inventory is sold. They are showing 1200 in the books at the end of the year. But what they are saying is the entire inventory has been sold. They are saying before the year end at the in the adjustment. It's a like separate thing. Okay. They have given additional information. So when the inventory is sold, do you think its history will be there, or it will be removed in the from the books, right? And any movement in that inventory will be seen or not? Will not be seen, correct? Because when inventory is sold, the cash will be realized, and the cash and the amount goes to cash account. Inventory is not there in the books now. Whatever the profit or loss has been earned will be shown in the P and SOPL, correct or wrong?
Yes, sir.
So this is not now seen. That's the reason why at the year end it is not there. And property, plant and equipment, already we have calculated the depreciation and everything. We have already discussed about that, right? This 90 how we got, correct?
Yes, sir.
That is because of the excess. The asset is like 1200 more than the previous amount. That means whatever the carrying value of the asset was there, this is more than this. So the excess depreciation will be there, and excess depreciation we calculated. It is 1 out of 10 years into 9 by 12. That calculation we did, and that is this, right? 90, right? And then we got this, and this again we will remove from the asset value, correct? Property, plant and equipment, is it so? And this will go into the goodwill calculation, because fair value of adjustment is taken in the goodwill calculation. So now this previous video we have discussed about this, correct na Isha, about excess depreciation.
Yes, sir.
Yeah, higher, the value is higher, that means we are showing at fair value, market value, so there will be excess depreciation. Now we will come to this, and we will do the consolidation part. So non-current assets, like if I take up those two values which I have shown you, so it will be 56,600 plus 16,200 minus 1110 at the end of the year. We will remove this, the movements part. So we will get 73,910. Now anyone has got any doubts? Anyone did not understand about this excess depreciation? I am ready to explain once again. If you did not get, if you tell me, I'll explain once again. Extra depreciation is, this is the movement, right? What has been told about the depreciation? What is the life of the asset? The life is given here.
Ten years,
Sorry.
10 years, maybe, sir.
Yeah, that's what I'm saying.
Not mentioned anywhere in the question, sir.
No. Actually, it's a old question, right? Previous question. So from that they have taken the, this one they have given, right?
Years.
10 years remaining life. Yeah. After the fair value, whatever the revaluation they have done, this is the amount, right? 10 year is a useful life, the remaining useful life. So we will take that 10 years here. That is because we are taking one year, this year we have to take the like excess depreciation, so 1 out of 10 years, and we will be taking only post acquisition things, right? Pre acquisition things will not be taken into consideration. So here we get excess depreciation adjusted, we get this value, and this one at the year end we have to do the adjustment. Okay. So like like we have to add this, sorry, why I'm subtracting, because there's a higher value, sorry, huh? So this is a higher value, right? This is the value which is like higher to the existing, like this much value was higher when the parent has acquired the subsidiary. The higher amount was by 1500 for both the assets, but we did the fair value adjustments, and we don't want on the date of acquisition. We want at the end of the year after doing all the adjustments, and henceforth we added and we got the non-current asset value. Now, see, now the next task I am not going to do simply. You have to find out the goodwill. See, and this is the data in front of you. You should do the goodwill calculation. I'm waiting for you. Okay, come on, start. I'm giving the time to you. Come on. Okay, are you calculating goodwill?
Yes, sir.
Yeah, just a second. Yeah, calculate. So shall I calculate goodwill for you?
Yes, sir. I calculated. Verify the answer.
Okay, no worries. We will calculate now. The goodwill calculation we will do. I think it's given. See, this is the consideration transferred. Already we have done this goodwill calculation also in the previous past. NCI at fair value is 3200 given in the question. Share, see, fair value of identifiable net assets at acquisition. So share capital is 2400. You already know that share capital of the subsidiary is 2400 on the, like when the company was acquired. We will take the fair values only, right? So this is the consideration transferred. This is the NCI at fair value. The share capital of the sub. See, we always know that total assets minus total assets minus like liability is equal to equity, right? So we always say this as net current assets. Sorry, net assets. Okay, so net assets or equity is one the same. So fair value of identifiable net assets at acquisition. On the date of acquisition, what is the fair value of identifiable net assets is what matters. So instead of taking total assets minus total assets minus liability, sorry, we will directly take the equity. So we will take the equity of the subsidiary company. Reserves 10,600 are given. We only want pre-acquisition reserves in case of goodwill calculation, not post-acquisition reserves. So 10,600, let me show you the reserves. So that will give you some sense of understanding. This is the reserves given to you, okay? And there is some point here, you should be seeing this. The Sanu's total comprehensive income for the year ending 31st December 2004 was 2 million. So in that 10,600, this element is the post acquisition earnings, right? Okay, that means on April 1st the company was acquired, but at the end of the year the comprehensive income is this. Accruing evenly throughout the year means this amount of 2 million can be spread equally for the entire year. That's called accruing evenly over the year. So what we will do, what matters to us is only pre-acquisition profits. So we will be doing one thing. We will be finding out the pre-acquisition profits. So 10,600 is the total profits. This 10,600 has pre-acquisition, has the post-acquisition as well as the pre-acquisition profits, because separately pre-acquisition profits are not given. Only they have mentioned about 2,000. That is, that too, this is at the end of the year, it seems. Okay, this is at the end of the year. So this year's current year's profit may be 2,000 for the entire year. What matters to us is we will remove the like post acquisition profits and we'll take only the pre acquisition. Okay, so 2,000 is the profit for the entire year. We will do one thing, because they are saying it is accruing evenly throughout the year. That means we can divide this 2,000 amount equally by 12. You can do this. So per month it is 166 something, it seems, right? 166.6666. But we want what actually? 2000 into 3 by 12 is what? Pre-acquisition. 2000 into 9 by 12 is what? Post-acquisition. Correct or wrong? Yes.
Yes, sir.
So we can, there are two methods to do this. Okay. So one method is this one, whereby we'll be directly like taking the 9 months value, removing from this 10,600. So we'll be getting pre-acquisition reserves. Or else like this is a better way. According to me, this is more easier to understand. Okay. Or else you can do one thing. You can take 10,600 minus 2,000, whatever it is you remove. You totally remove this and then find out that T by 12 amount and add. So you'll get the answer of that also. Anything is okay, but this is more simpler to understand. So 2000 is something whereby two divisions will happen. 3 by 12 is pre-acquisition, 9 by 12 is post-acquisition. Pre-acquisition is already included in this 10,600. If we remove the post-acquisition profits, we directly get pre-acquisition profits. Did you understand now? 10,600 has the entire profits from Jan 1st till December 31st. That is, it also has pre-acquisition profits. What we want is only pre-acquisition profit for calculating goodwill. So we need to remove the post-acquisition profits from this total profit, which is at the end of the year. So 2,000 is something which is the other comprehensive. They have said the comprehensive income at the end of the year is 2,000. That means this year the earned profit is this. So out of that we will remove the post acquisition part. Okay, we will remove this part, 9 by 12 part. So 3 by 12 is already included in this. That entire total thing what we have, from that we are removing the 9 by 12 part. That means 2000 into 3 by 12 comma 2000 into 9 by 12. This gives the total year's profit, right? This is the pre-acquisition part, which is already there in this. This is the post-acquisition part, which we will remove from this. So we'll get the pre-acquisition reserves. Now we have this. And then one more thing you should be understanding. There was the impairment loss also given in the question that I will show you. The NCI is given at 3.2 million. Already we know. an impairment test conducted at the year end revealed that consolidated goodwill of Sanus company was impaired by this much. So this impairment test was conducted at the year end, right? But this year end data doesn't matter for us. It matters for us because we are finding out the goodwill on which year end they are saying. At an impairment test conducted at the year end revealed that consolidated goodwill of okay, that is consolidated goodwill. Once we will find out that goodwill value and then impairment review is done for that. Okay, so this also should be adjusted. Yeah. So before going into all that, we will take this point here. Okay, this is what we have found out the pre-acquisition reserves. Then fair value adjustments already we have calculated here 1500. You already know that 1500 thing. You can see that 1500 here at acquisition date. That is also adjusted. So that is also adjusted here. What is that? In goodwill calculation. So this entire amounts makes it to 13,000. So your goodwill is how much? 4,000, right? But one thing, goodwill is what you're going to show at the end of the year. Am I right or wrong? And this goodwill has been impaired by 150 is a special adjustment given. So 150 removed and hence your goodwill is how much? 3,850. Everyone clear? Isha and Prerna, is it clear for you? Hello.
Yes, sir.
So can you repeat?
See, this is the consideration transferred. This is the NCI at fair value. This is the share capital which we have already discussed, right? Equity. We have taken the pre-acquisition retained earnings or reserves. Fair value adjustment we have done. The entire amount of this becomes 13,000. When we adjust all this, we get the goodwill value. But they have clearly mentioned that goodwill, which is an intangible asset, which will be shown in the balance sheet because they have clearly mentioned that consolidated goodwill. So when you will be consolidating, when you will be preparing the consolidated statement, you have to show intangible asset or goodwill in the balance sheet, right? You'll be showing at this value, but you should know one thing, that goodwill is impaired by 150 or something. They have 150,000. So we'll do that. We'll remove that impairment loss, or you can do that in the balance sheet also, but we usually do in the working notes, right? So the actual value of goodwill you have to show is 3,850. Now any doubts? Hello. Now any doubts?
No, sir. Understood.
Understood. Isha, are you hearing? Hello. See, many of you may get confused like how come impairment has come here. See, impairment review will happen at the end of the year, right? So when the impairment review was done, 150 was the impairment loss. So we removed and we got the actual exact goodwill value. So we will take this in the balance sheet. This is the total of assets, right? Now let's go for the inventory, and inventory has certain more adjustments, it seems. Related to unrealized profit, because the question belongs to unrealized profits. Okay, now inventory, what is the inventory value given? 2,900 plus 1,200, they themselves have mentioned here, right? But inventory, there is unrealized profit in inventory case. We should see that carefully. On 1st October, Sanus company sold goods to Potter's company for $200,000 at a gross profit margin of 40. See, I have already told you, related to inventory, which is like sold and purchased, or the inventory, yeah, sold and purchased, or it's an intercompany transaction, right? It's between the parent and subsidiary. So we should, whatever the profits here the subsidiary company has sold the inventory to parent company, goods to parent company and they have made a profit of 40%. We should remove that. Okay. So 200,000 into 40% is how much? I think 80,000. So we'll take 80 and we will remove that from inventory, and the same thing we have to remove from the retained earnings. Correct or wrong? So for since the profit is unrealized, previously when they were separate companies, they realized that profit. Now we have to show them as unrealized profit or show that as unrealized profit. So whatever has been credited in retained earnings previously, as profit, should be removed. So retained earnings will be now debited, and inventory which was debited previously with higher amount should now be credited. So journal entry is also there by how much? 80, 80. Okay, so we will remove that now. Unrealized profit. Now trade receivables. We have to now see the trade receivables thing. So receivables, what they have given, the goods were still in Potter's company inventory at the year end. No other sales were made between Potter's and Sanos in the year. Potter's company current account with Sanos company is 130 credit. That means Potter's company is maintaining a account with Sanos company of how much? 130 credit balance. 130 credit balance means what? Potter's company current account with Sanos company was 130 credit. That means Potter's company has to pay how much to Sanos company? 130, right? It is receivables, payables, intercompany transaction, correct? Has to be cancelled. So we will remove this 130 from the receivables and we'll remove 130 from payables. Okay, intercompany transaction. If I maintain some credit balance with someone, that means someone in their books, here it is clear, right? Potter's company current account with Sanos company was 130. That means Sanos company is showing that Potter's is supposed to pay them 130 and Sanos is supposed to receive 130. So since it's a consolidation we are doing, we will remove 130 from receivables and payables. Why? Because when consolidation is done, it is considered that some transaction has happened between the companies, because now it's one company itself, right? There's no point of like assuming them as two separate companies. When they were two separate companies, receivables, payables were shown in their books. Now no receivable, payable, because it's one company now. This did not agree with the equivalent balance on Sanos books due to cash transit. So whenever I speak about cash transit, there is a current, there is a there's some money coming, right? The money coming from one party to another party. But when when you do the consolidation, you never think that money is coming or money is going, right? You always think that the money is in the company itself. Okay, so for cash in transit, for cash in transit cash in transit means the parent, here you can see this did not agree with equivalent balance in Sanos books due to cash in transit of 70. That means Sanos has to get the money of 70,000, right? And they did not receive this money until the year end. But now in from whom? From parent. From whom? From parent. So now this money, do you think in consolidation the status will be like they are supposed to receive money from parent? No, it is presumed that the money is in the business itself. So we will add this 70,000 to cash account and we will remove this 70 from the receivables. Hello, are you
Yes, sir.
understanding? Are you understanding, Prerna?
Yes, sir. Can you just repeat the 70,000 thing again?
See, for cash in transit, the journal entry should be clearly known. Okay. So here I'll write the journals. Cash in transit. See, first of all, when there is a consolidation, there is nothing to be considered like transit. The cash is in the group itself. Understood? Hello? See, parent and subsidiary, right? So subsidiary is supposed to receive how much from parent? 70.
Yes.
Parent has said that I have sent this 70. You will receive it very soon. Correct? Yes.
Yes. Yes.
So now in the consolidation, now the status of payables is not there. Is the status of payables there now
No.
when the cash has been sent?
No, it's still in transit, right?
Yeah, it's in transit, but it is considered as receivables, right? By whom? By
Yes.
the subsidiary.
Subsidiary.
So for parent, the money has been sent. So now from there the thing is clear. For these people the thing is not clear because the money hasn't reached them. But when you make a group account, the cash is like in the company itself, and there is no receivables now. Correct or wrong?
Yes, sir.
Why there is no receivables? Because it's like one company now. Fine.
Yes, sir. Got it.
So we will remove this 70 and we will like add cash to this. So the entry would be cash account debit because money is added up to receivables account. Okay. Now this is also done. Yeah, now we will move forward. Now still what is there? Cash is done. You already know that share capital of the parent is only taken, right? So share capital is how much? 8,000. Reserves we have to distribute. Share capital of the parent is taken, and now reserves we will go for the work, we will go to the working notes. Yeah, so you know this was the reserves of the subsidiary company, out of which fair value movement is removed. uh, but why I'm taking this is the goodwill one. I shouldn't be considering this because these people have written everything here, so we can take it like that, right? So I think we need to calculate the reserves amount right now. So we will do that here. We'll see some space. Yeah, we will do here. So consolidated reserves. So we'll take parent, we will take subsidiary. Okay. As per the question, 54,100 is parent's reserves, 10,600 is subsidiary's reserves. We already did this, right? As per the question. And from this we will remove the fair value movement 390. Why we will remove fair value movement? Why? Because like this is the fair value adjustment, right? At the end of the year, what is the retained earnings? We want that, or reserves, we want that. So 390 like at the end of the year, because the movements we have already calculated here. At the year end, you know, this movement which was adjusted from this 1500, and the profit at the year end, like you know, the fair value adjustment at the year end is seen here, right? So this 390 exactly is nothing but fair value movement. So any positive movement should be added to the retained earnings, any negative movement should be subtracted. It's a negative movement. That means it has taken the value downwards, okay? Inventory and depreciation. So we will take that. So fair value movement, it is done. Next point, you know, already we have discussed that inventory has been sold by the subsidiary to parent, and there is an unrealized profit. And unrealized profit we have removed from inventory, and the next adjustment is nothing but to remove it from retained earnings, right? Because the inventory hasn't been sold to third party, so the profit is unrealized. So in consolidation, when we do the consolidation, since separate books were maintained, profits was recognized. When consolidation is done, profits cannot be recognized. So unrealized profit we have to remove, and we will also remove the pre-acquisition reserves, because we want, see, you always should understand, only the post acquisition profits are distributed amongst the parent and NCI. Okay, so pre acquisition reserves we will remove 9100. So you just calculate this, you will get 1030. This 1030, out of this 1030, how much, what is the acquisition? 80% goes to parent, and 20% goes to NCI. Okay, and there was an impairment loss also. See, when profits are enjoyed, the losses should also be borne. So we see, impairment loss we only adjusted for goodwill, but we did not do any adjustment to retained earnings till now. Huh. So there is an impairment loss which should be adjusted, right? So 120 I am adjusting, and the impairment loss 30 goes to NCI. Okay, they have to also bear now. So this totally makes it 54,804. Okay, so I will put this in the balance sheet, 54,804. $54,804 is the balance sheet. Now coming to NCI calculation, you know already NCI at fair value was 3,200. NCI. Now 150 was the total impairment loss, right? 120 has gone to parent, 30 will go to NCI. So 30 we will subtract impairment loss, and also the gains, right? The gains will also be given to the NCI. So what was the amount there? 1030, right? 1030 into 20% we will take. That is how much? 206 gain. So this will be 3376. Okay, done. And these are the non-current liabilities, current liabilities. I think all the adjustments are done completely, or any adjustment is left over in the question. I don't think now. Everything is done, if I'm not wrong. Yeah, payables also we adjusted, right? 130. So the payables value is 3670. So your balance sheet, if you do the equity and liabilities total, it will be 87,850. And asset side also, every adjustment is done. Okay. Asset side, it will be all the adjustments. Long term, it is 18,000. Yes. And this is 3,670 I have taken. Yes. This is the total I have taken. Yes. Yeah, done. Asset side total is how much? Asset side total 87,850. Okay. Now you can check this out. If any doubts, you can let me know, Prerna.
Yes, sir.
Anything, if you have doubts, you can ask.
Sir, I understood.
Okay, okay. So this question is done. One more question we need to do, that is like the last one. Intra-group sale of property, plant and equipment. Illustration is there. And then I think activity is there. So we'll do this question. I think we did this illustration. Okay. Once I'll check this whether I've done this or not in the previous class. Okay, let's do this question. Intra-group sale of property, plant and equipment. So Percy Company owns 60% of the equity shares of Edmund Company, giving Percy Company control over Edmund Company. Okay. On 1st Jan 2001, Edmund Company sold a machine with a carrying amount of 10,000 to Percy for 12,500. Just read this. So Percy Company owns 60% of the equity shares of Edmund Company, giving Percy Company. So since it's a 60% acquisition, there's a control of the parent on subsidiary, right? So on 1st Jan, Edmund Company, the subsidiary, sold a machine which has a carrying amount of this much at this much. Do you now 10,000 worth non-current asset is sold at 12,500. There is a unrealized profit of 2,500, right? This is this unrealized profit should be adjusted now. From the asset value, this should be removed, and from the retained earnings, this should be removed. Same treatment like the inventory, and also excess depreciation should be seen. Okay. Since excess depreciation has been considered, we need to adjust that also, reverse that also, as if there was no transaction between them, because now when you consolidate they become one single company. When they are separate companies, this kind of transaction can be considered, but when they are single company, okay, one company, you cannot like, there is no profit earned, okay, and there is no transaction has happened, and no excess depreciation is there. That is the kind of treatment should be, that is the kind of thought process you should have always, right? See, when these are separate companies, it is understood fact that they will maintain separate set of books, and they will show these transactions as if they are doing the business with some third party. But when you do the consolidation, this particular sale between two companies will be thought as if nothing or no sales has happened, no profits have been earned, and no excess depreciation has happened. Right now, the reporting date of the group is on this, and the balances on the retained earnings of the Percy and Edmund company at that date are given. This is the parents, Edmund, Percy. Okay, this is the parents retained earnings after charging depreciation of 10% on machine, and this is the Edmund company's retained earnings, which already has included the profit on sale of asset. Okay, so now parents retained earnings is taken, subsidiaries retained earnings is taken. We will first remove the uh, unrealized profit, okay, because when you consolidate, this hasn't been earned, because now these two will become one single company. So so when there are two companies, how come you will consider that some sale has happened, and how come you will consider that some profit has been earned? Nothing like that. So this is the actual retained earnings. Now, excess depreciation which the parent has shown, because 10,000 worth of asset which was of subsidiary, okay, has been sold to parent. When they were maintaining separate set of books, definitely parent has shown the asset at 12,500 value, okay, that is 2,500 extra than the 10,000. So definitely this extra value what he was showing the asset at, excess depreciation also he has kind of recorded, or he has shown, okay. So that will now be adjusted, okay. So now excess depreciation 250, okay, and what is that? So excess depreciation has reduced the profit by 250, correct? Hello,
Yes,
hello.
sir.
Excess depreciation has reduced the profit by 250, right?
Yes, sir.
Now to correct, now to do the, now if I have to see that no no the if I have to show them as one company, if I have to show the parent Percy and Edmund as one single company, I will consider that no transaction has happened between them, and no excess depreciation has happened between them. So the excess depreciation which has reduced the profit by 250, okay, that means extra subtraction of 250 which was happened. Now we will add back that 250, right or wrong?
Yes, sir.
So we are adding, okay. This excess depreciation has eaten away the profit of the parent when it was a single company, but when they get consolidated, what transaction has happened? Nothing. What profit has been earned? Nothing. So where is the question of excess depreciation? No. So nothing has reduced the profits, right? That is the treatment. So 15,000, 15,500 will be kind of taken by the parent, because they really have invested in the subsidiary. So 60% belongs to them and 40% goes to NCI. Okay. What is this? The profit on uh, transfer of, yeah. So just add this now, Prerna, all these values.
Yes, sir.
How much you got?
1 second, sir.
Yeah, yeah.
Sir, we have to add 36,550 as well.
Why? This just the total of the retained earnings, right?
Yeah, yeah. Okay.
Consolidated retained earnings.
100.
27,000 plus 250 plus 9,300. You do?
Okay. Minus 36.
Out of that,
36.
sorry?
36,550. It's the same answer.
Okay, right. Done. Okay.
Yes.
Now, this activity you should do as homework. Done with this chapter, we have to now start with this
So we're going to do P&L next.
P&L. Okay, or else I'll start working capital from like investment decisions and wind up. That because almost those two chapters, if I do, FM is done for this online batch also. Okay, so we'll see
Yeah.
next class what to do. Fine.
But sir, cost of capital and everything is left, I guess.
That I have already given the videos. They are following. Okay.
Okay, okay, okay.
We will do questions. We'll start revision part, right? So we will take up questions from kit and we'll solve in the class, right? That's what I'm going to start the revision in like within like from Monday onwards almost, because this 2 3 days, if I finish by this week, if I finish working capital 2 chapters, only one chapter is their source of finance. So
Okay.
I'm about to wind up and then start the revision part, whereby I'll be doing a lot of questions from cost of capital, working capital, all the questions. Okay.
Okay. So, sir, like FM revision will be going on in the this online class, right? So, when I come in the morning, should I
Then
focus on
I
FR?
will I will call you right now. 2 minutes.
Okay, sir. Okay.
Yeah, yeah.